For 18 months, every wealth advisor in America was bracing for the same date, January 1st, 2026, midnight, the deadline the entire tax planning world had been counting down to. The Tax Cuts and Jobs Act was supposed to die that night. And on January 1st, family offices opened, the markets opened, the advisors sat down at their desks, and nothing happened. Let it land. The cliff everyone spent a year and a half preparing for. It got canceled. 6 months earlier, on the 4th of July 2025, the rules were quietly rewritten. The sunset was called off, and almost nobody outside the top floor of private banking fully understood what that meant. Fortress Wealth, Episode 3. Here's what actually happened, and why it matters more than the version you were told. The law that was supposed to expire didn't just survive, it was made permanent. The brackets you have now, they're locked. The deductions everyone said were disappearing, most of them got bigger. And while regular people exhaled and moved on, the smart money did something else entirely. Because permanence isn't the end of the game. Permanence is the starting gun. Because here's the part nobody's telling you. The same bill that made your tax cuts permanent also planted new deadlines. Some of the best moves on the board right now expire in 2028. One of the biggest expires in 2030. So this is the briefing you should have gotten the week it passed. 7 moves. The wealthy made the moment the rules became permanent, and the clocks that are already ticking on every one of them. Let's get into it. Look at the left side. That's the doomsday everyone planned around. Higher rates, half the deduction. The business break, gone. The estate exemption, gutted. Now look at the right side. None of it happened. On July 4th, 2025, a single piece of legislation rewrote the whole board. The brackets, 10, 12, 22, 24, 32, 35, 37%, made permanent. The doubled standard deduction, permanent and indexed up every year. The 20% business deduction, permanent. The estate exemption didn't fall to 7 million. It was raised to 15. Everything the planning industry was bracing for, reversed. But here's what the relief headlines missed. The same bill that made the cuts permanent also planted brand new expiration dates. A massive deduction that quadrupled overnight, set to collapse back down in 2030. 3 new write-offs for everyday workers, that vanish in 2028. And a small business provision that just got the most powerful upgrade in 30 years, but only if your stock was issued after a very specific date. The wealthy didn't relax when the cliff got canceled. They looked at the new clocks and started moving. So here's the framework. 2 kinds of moves. The first kind exploits what just became permanent. The things you can now build around with total certainty for the first time in a decade. The second kind races the new deadlines. The windows that are open right now and won't be later. 7 moves. Let's start with the one with the loudest ticking clock. Strategy 1. For 7 years, if you lived in a high-tax state, you could only deduct $10,000 of your state and local taxes. $10,000, no matter how much you actually paid. That cap quietly crushed homeowners in California, New York, New Jersey, Illinois. That cap just quadrupled. For 2026, you can deduct up to $40,400 of state and local taxes. Picture a household in New Jersey paying $18,000 in property tax and $15,000 in state income tax. $33,000. Under the old cap, they deducted $10,000. Now they deduct the whole thing. But, and this is the move, that $40,000 cap is not permanent. It steps down a little each year, and in 2030 it slams back to $10,000. This window is open for a handful of tax years, and then it's gone. So the wealthy are doing 2 things. 1. If you stopped itemizing because the old cap made it pointless, you rerun the numbers now because with this cap, itemizing beats the standard deduction for millions of people again. 2. Any state tax payment you have discretion over. You're timing it into the window, not after it. One honest note, and I'll say it once for the whole video. I'm not your accountant, and above $500,000 in income, this cap starts phasing out. This is the map, not the turn-by-turn. Take it to a real CPA. Okay, strategy 2. Strategy 2. This is the one Wall Street organizes everything around, and it became more valuable the day the rules locked. Money you earn from a job, a business, interest, that's ordinary income, taxed up to 37% at the top. Money you make from selling an investment you held over a year, that's a long-term capital gain, taxed at a top rate of just 20%. That's a 17-point gap. On the same dollar. Decided entirely by how the money is classified. So the entire playbook becomes earn less of your money as ordinary income and more of it as long-term gains. 4 levers. 1. Hold every investment past 365 days so it converts from ordinary to long-term. 2. Tilt your taxable portfolio toward qualified dividends, which are taxed at that lower rate, not the high one. 3. When you sell a business, structure the exit as a capital event, not a paycheck. 4. Spread a giant sale across multiple years with an installment sale so you stay in the lower gain bracket instead of getting pushed up. This isn't a loophole. It's architecture. The whole wealth-building game for the next decade is organized around that 17-point gap. Strategy 3 is the one I'd tattoo on every founder watching this, because it just got the biggest upgrade since 1993, and almost nobody has noticed. Strategy 3. There's a provision in the tax code that lets the founder of a qualifying company sell their stock and pay 0 federal tax on millions of dollars of gain. Not deferred, not lowered, erased. It's called Qualified Small Business Stock, Section 1202. It's been around since 1993, mostly ignored, and the July 2025 bill just gave it the biggest upgrade in its history. Here's what changed. Before, it was all or nothing. Hold the stock 5 full years or get nothing. Now there's a ladder. Hold 3 years, exclude half your gain. 4 years, 75%. 5 years, the full 100%, tax-free. The cap on how much you can exclude jumped from $10 million to 15, and the size of company that even qualifies went from 50 million in assets up to 75. So bigger, more mature startups are back in the game. But here's the catch that makes this a move, and not just a fact. These supercharged rules only apply to stock issued after July 4th, 2025. Stock you got before that date stays on the old, weaker rules. So what are founders doing right now? They're looking hard at converting to a C corporation and issuing fresh, qualifying stock on the new side of that line. Because the difference between the old rules and the new ones can be millions of dollars at exit. And the 1999A business deduction everyone thought was dying? It's permanent now, too. Founders didn't lose a thing. They got handed a bigger weapon. Strategy 4. For years, the Roth pitch was all panic. Convert now before rates go up in 2026. Well, rates didn't go up. So does the Roth still matter? More than ever. Because the thing that just changed isn't the rate. It's the certainty. For the first time in a decade, the brackets are permanent. You can finally plan a Roth strategy across 10 years without guessing what Congress does next. Here's the move. The Roth conversion isn't about a year on the calendar. It's about your lowest income year, a sabbatical, a gap between jobs, the first slow year of a business transition. That's when you convert, because you pay the tax at your lowest rate, and then it grows tax-free forever. $200,000 in a Roth, growing at 7% for 20 years, is roughly $770,000. And not 1 cent of that growth is ever taxed. And if your job offers a Roth 401k, there's no conversion tax at all. You just fund it. That's the zero friction version, available to almost everyone watching. Strategy 5. Real estate. The 1031 exchange survived the chaos completely intact, and it's quietly one of the most powerful wealth tools that exists. Here's the mechanism. You sell an investment property, And instead of paying the capital gains tax, you roll the entire gain into the next property. No tax? Then you do it again and again. Every gain deferred indefinitely. And here's the part most people don't know. There's a vehicle called a Delaware Statutory Trust, a DST, that counts as a 1031 replacement. It lets you roll your gain into institutional-grade real estate, big apartment complexes, industrial parks, completely passive. No tenants, no toilets, no 3 a.m. phone calls. And then the endgame. If you hold that chain until you die, your heirs inherit at a stepped-up basis. Every dollar of gain you deferred across your entire life, it doesn't get paid. It disappears. That's how dynasties build real estate for generations and never pay the capital gains tax. Buy, defer, die, repeat. Strategy 6 is a warning, and it's the one hiding in the fine print. The alternative minimum tax, the AMT, is a second parallel tax system. You calculate your taxes the normal way, you calculate them the AMT way, and you pay whichever is higher. Now the AMT exemption stayed high. That's the good news. But the July bill quietly tightened the screws on the back end. It pulled the income level where that protection starts phasing out back down, and it doubled the speed of the phase out. Who gets hit? The person with a big stock option year. If you work at a tech or growth company and you exercise a pile of incentive stock options in a single year, you can trigger a giant AMT bill that blindsides you in April, a tax you didn't even know existed. The move is simple, and almost nobody does it. Don't look at this in April. Look at it in November. Run the AMT projection before year-end and spread your option exercises across multiple years instead of detonating them all at once. If your tax bill surprised you this spring, the AMT may be exactly why. Strategy 7 isn't a tactic. It's the whole point of this series. Think about what just happened. For 18 months, the smartest people in finance prepared for a tax cliff. They restructured. They rushed gifts out the door. They lost sleep. And then, at the last minute, the cliff got canceled, and half of that scrambling turned out to be unnecessary. But there was a group of people who slept fine the entire time, who changed nothing on January 1st, who didn't care whether the cliff fell or not, because their wealth wasn't sitting on top of any one tax provision. It was already inside structures that don't depend on what Congress does. Roth accounts converted years ago, Dynasty trusts that outlast any exemption, life insurance cash value that survived every tax regime since before most of us were born, 1031 chains that just keep rolling. The cliff was a stress test, and the results are in. The people who built on permanent structures didn't feel a thing. The people who built on a temporary provision spent a year and a half terrified. And here's the part that should stay with you. The cliff didn't fall this time, but it was real. It was 18 months away. And the next one, the SALT window in 2030, whatever the Congress after this one decides to do, is already on the calendar. So build the thing the tax code can't reach. Build it first. Everything else is just maintenance.